Good morning and welcome to the energy market summary for Magnus Commodity for the first week of May this 2024. And we will start with the oil market as the shifting geopolitical landscape is keeping the energy markets on the edge, as we know. Last week, the oil Brent reference plummeted up around 7%, registering its largest fell in 3 months. That's reflecting the reduction in the geopolitical risk premium, in particular the Middle East, where potential ceasefire agreement has been under discussion between the two warring parties. However, oil prices were probably recovering from last week's overdone sell-off, and we can see a slightly bullish trend in these last days. On Monday, Hamas agreed, as I mentioned, a ceasefire proposal from Qatari and Egyptian mediators. However, Israel rejected the proposal, citing that the deal was far from meeting Israel core demands. The negotiations are continuing as Israel troops are entering in the city of Rafah in Gaza, backed by air strikes. On another bearish news, the cartel, along with its allies, including Russia, is now expected to meet next June to discuss further production reductions or cuts. So the idea is to tighten the market, push the prices slightly or higher than the current prices that were moving below the $90 per barrel. Whereas the oil market has been on a bearish trend, we can see that the gas market or the European gas natural market is fluctuating, and there's many reasons here. We have been above average temperatures in the last weeks, together with the strong expansion of renewables and the high nuclear availability and the limited gas growth, around 2% on the year-to-year since last winter, has maintained the prices quite low comparing to the last 2 years. So prices have fell below the pre-crisis level in Q1 2024, but it's still far from the prices seen previous to 2020. We expect an increase on demand this 2024. The industrial sector is set to account almost 45% of the global gas demand growth in this year, partly driven by the recovery in Europe and the price-sensitive Asian markets, as well as the structural growth in China and India. China alone is expected to account 30% of the global gas demand growth in this year. On most bearish fundamental, we find that Europe just closed the 2023-24 heating season with the all-time high inventories levels, meaning that the injections needs this summer could be 35% below their 5-year averages. So we would expect to reach the 90% storage level by August this year, even though the target is set for November of this year, right? In any case, geopolitical tensions can be easily distorting the gas market fundamentals, and what it seems to be a very stable situation could change quite quickly if the geopolitical situation get worse, right? On the LNG overview, we are on a big wave of new infrastructure coming into the markets. We expect we expect a new imports coming to the European region in the coming years, and has been increasing in the last months. So the situation or the market, gas market, is getting more and more flexibility right now. As I mentioned previously, the gas storage level has reached 64% right now, meaning that we are well situated in the historical figures, and quite aligned to reach the targets for November this year. And the withdrawal of the storages are quite aligned with expectations and the demand situation. So all in all, there's no tensions regarding the availability of natural gas in the European regions, right? As a result, we are still moving in, let's say, a tunnel of prices since December 2023. As you can see, is a different price level previous to the crisis, 2022-2023 crisis, and the market just has been recovering since mid-March, and right now is reaching values close to 37 euros megawatt on the calendar products for TTF, the European gas reference. In another level, we find the spot market is still quoting and behaving better in terms of pricing that any forward product on the market, right? All in all, we are averaging prices below 28 euros per megawatt in Europe on the natural gas spot prices. Only this last May, so far, we are averaging above 30 euros per megawatt, but till now we have been below this figure. On the contrary, all the forwards market, especially the closest to the delivery, are quoting above 30 to 35 euros per megawatt. That's pushing and gathering all the uncertainties and the geopolitical tensions on the market. As a matter of fact, this last year and a half, we have seen better behavior of the average spot prices on natural gas. As you can see in this graph, any futures product quoted in this last year and a half, and just gathering the last quote, has been worse than the real spot average price for the same period, and we can see that the difference are quite significant. As a matter of fact, we can see that spot prices on 2023 were almost 55% below the last quote of the calendar product. And since then, any calendar and any quarter product has been higher than the real spot average, in different percentages. We have been right now, the last, let's say, the most fresh ending forward product, which is the Q1 2024, has been the spot price has been almost 18% below the last quote of Q1 2024. So we are still facing the hedging strategies with the futures market with premiums that could be potentially against the budgets. In another level, we've got the ETS carbon market and the coal market. Both of them are quite aligned and correlated with the LNG market. So as we have seen on the LNG prices, we reached a minimum values on mid-March this year, and since then we are back on prices seen on the starting of the year. So right now the ETS market, the carbon market, is quoting above 70 euros per ton, and seems to be holding a strong bullish trend since the minimum seen on March this year, despite the fact that we have closed a very optimistic year where greenhouse emissions have been reduced of almost 8% in Spain in 2023 compared to the previous year. So all in all, the trend is similar to the gas market, and as a result, we've got an electricity market here. I take as an example the Spanish one, but we can go to the different power markets in Europe. We are averaging a really interesting spot prices, well below the last 3 years, where the shock natural gas market pushed the prices of the power on their maximum levels, and we have been closing record low prices on certain moments. So, as a matter of fact, we can see the average spot prices in April this year were below 14 euros megawatt, whereas the previous best one was on the COVID 2020 April, that quoted below 18 euros megawatt. So far, the low demand and the big production of renewables have been pushing the spot market to a very, very competitive prices in terms of buyers, right? As a matter of fact, the new capacity of renewable production in the market have been, and the low demand have been, we have seen negative hour prices in 27 of the 50 billion zones in Europe. So has been quite a situation in Europe that has been pushing the prices really, really low. As a matter of fact, the Renewables Association urged the European Commission to address negative pricing situation, warning that it jeopardized the investment, and the renewable need to have a more strong price signal to ensure the investments for the coming years. On a different level, we find out that futures market for the natural gas, we see that the settlement prices are well above the average spot prices. Moreover, we start to see again an increasing spread between the different calendar products in the Spanish market, where all the pressure of the premiums are located on the calendar 2025, quoting right now on yesterday's settlement prices are above 65 euros per megawatt, whereas 2026 and 2027 are quoting below 55 euros per megawatt. It's a 10 euros gap in just 1 year. Quarters are in the same situation, where the best quarter for this year is at 77 euros per megawatt, which is Q3 2024. The same analysis carried out on the energy sector and on the powers market in Spain shows that the spot market is still performing better than the forwards market for budgets. For the buyers, meaning not the producers. So we can see a huge difference between the last quote of the calendar quarter products in the different exchanges for the Spanish market and the real spot average prices for the same period. As a matter of fact, Q1 2024 right now just quoted 41% below the last quote of the futures market. So again, we have to take this into consideration in the moment we apply our strategy policy and hedging policy. And with that, we can end up the summary of the situation. We can see that the evolution of on the recovery of the forwards prices in Europe seems to be quite correlated, and the fundamentals are the same for all of them. So all in all, bullish sentiment on the forwards market, whereas lateral sentiment on the spot markets, both natural gas and power. Thank you for attending this meeting, and looking for you seeing on the next summary. Goodbye.